Okay, good day, everybody. This is Jim Kinney, and this is the weekly update for optionprofessor.com on the markets as I start. And of course, this is for the week of that just ended here. I'm broadcasting on March 23rd, Saturday. We had some technical difficulties yesterday, so we switched it over here. Also, starting out, I always say past performance not indicative of future results, and always when you're doing short-term trading or option trading, use risk capital, substantial risk of loss. And of course, quick background on myself: I'm a graduate of Boston College, and I've been in this investment arena for decades. I've been doing webinars and seminars on the option market for decades, and have educated thousands and thousands of investors nationwide. So at the end of the day, I'll be showing you my opinions and my views on what's going on a number of markets, and give you my slant on what's happening. Okay, we had a big week, so let's get right into it. We got into a situation here where the market really went in the dump on Friday. And overall, what I've been saying and talking about is when we hit the low at 2350, there were those who I subscribed to that thought we could go back to the 200-day average and that every dip would be a buying opportunity. That proved to be pretty accurate because we did go back towards the 200-day average around 2750. Then I started listening to some other people who, because I try to get my net as wide as possible to come up with an idea that I can live with, and the Elliott waivers. Had thought that we would snap back from the 2350 towards 2800, and then they raised it up towards 2940 as an overshoot, testing the high. Well, it got up towards around on the S&P, up towards that 2850, maybe 60 area, but then it turned down violently here in the last day or so. So is the 2940 retest still on the table? It could be. We'll have to see how next week shakes out. But it also could be a situation that the pullback move may have commenced. We've got a situation here. As you can see, there's the market as the close, 460 lower. Let's put up the S&P over here, since we're talking about it, and you can take a look at it and see what I am seeing, and obviously draw your own conclusions. Where are you here? Here's the S&P. There you go. Down 54, and it broke through that 2815 area, which some people thought were kind of important. But I'm going to show you right now what I think might also be important is that it is coming down to that 2800 area where it kind of had a double top, right? Look at all that resistance. Boom, 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 2800. So if it can hold 2800, and things turn around a little bit, I don't think the 2940 is totally off the table. A lot of people think there's more selling to come, and it certainly looks that way. And certainly, if we bust through 2800 and then 2700 there, obviously the possibility of going down towards these 2600, 2650 area might increase significantly. I still don't see it going all the way down to the 2300 with the unemployment rate, with the economic numbers we're seeing, and some pretty decent, although not write home about type stuff on the earnings. So anyway, there is your technical picture as far as I can see. So very important to hold this 2800 ballpark area. It's closed right on the low. And if we do bust through it, if it goes back above it quickly, then it could just be a spook job where they got everybody scared and then came back up. So this neighborhood here, very important. This neighborhood around 2700, very important if you're bullish. If you're bearish, obviously you got a high point this week of around 2460 area ballpark, and that would be obviously your line in the sand. If you want to be bearish, you got to have a line in the sand, and therefore that might be your line in the sand this week's highs. Okay, let's see what some of the other markets, because what was telling us that it might roll over, and it told us it was going up as well, is the transports. So I watched the transports pretty closely, and let's see what that was telling you. While the market went up and made a new high on this move, you'll see that the transports never did. And you can see the transports are on the big defensive as well, but it's right at that 10,000 support, right? So there you go. You had a high point there where my cursor is. You had a low around there. You had another low there. And now we're right around that 10,000 again. So next week's kind of big. We start breaking well under 10,000 and it stays there. That would increase the odds, in my view, that the correction or the pullback may continue further. The other thing is, as I said in my other broadcast, I thought the market was going to get choppy here because a lot of the moving averages are still inverted. Even though the market went above the 50 and the 200 day, they still are inverted. And that indicated to me that we came up very fast, very quick, and that the likelihood of it just keep going without stopping was pretty low, and that a pullback or a consolidation might very well be in the cards. I'll give you, for instance, we went above, I believe, the 10,524 area during this advance, right? But look at the 50-day average on the transport, 10,195. Okay, so it was inverted, which means to me, my opinion, that you don't trust this rally. Okay, and because the inversion is nothing to write, to nothing to sneeze at. Okay, the moving averages are technically not in a great position when they're inverted. Okay, and the moving averages are based on price and price and time is a factual thing. So I like to use them as a gauge, as part of a gauge, and because they're not based on opinion, right? Price and time are not debatable. Now, with regards to the closing price, that's a lousy closing price, right? You're under the 50-day again, and you're under the 200-day. So that's why I say that people who think that there's more to follow, they're not exactly, have no evidence that that could be the case. Look towards the S&P. I'll show you the inversion there, and you tell me what you think. And you can shoot me an email on anything you've got as a question or a comment. Again, if you have any friends or associates who are in the market and want to go to the broadcast, just tell them to go to optionprofessor.com and get the link every week. Also, if they have a question, just shoot it over to me, optionprofessor@gmail.com. Option is singular, option professor. All right, there you go. You got the S&P. Let's get the detailed quote up here and check it out and see what we got. There you go. Okay. All right. So where are you here? You got the 50-day average at 27.34. You got the 200-day at 27.55. Remember I was telling you at 23.50, the guy who I was kind of listening to a bit was looking for that 27.50 200-day average to get tested. It did happen, and then it went through it by about 100 points, and then after that couldn't hold its water. Why couldn't it hold its water? Who knows? But I'll tell you one thing that wasn't good is that the 200-day and the 50-day are both inverted still, and the market though is still above that number. But the fact that the transports have gone through their numbers like a knife through butter, obviously a lot of it has to do with Boeing and stuff like that, but I still think that's not a good sign. Let's look at that Russell. Okay, because we're looking for indicators, and the Russell and the transports have been very good to me as far as giving me an idea of where we're going. With regards to the Russell, down 56, never made it above to a new high, right? Went to that 1600 area, couldn't make it above that. And that 1600 looks like a heck of a nice resistance zone. If you break above that, you got to take the bull cap out, but we're 100 points underneath that right now. Let's take a look here now at the detailed quote. And again, we had a big rally back up towards almost 1600. Now, during that rally, what was the moving averages doing? Okay, well, they were 1523 and 1581. So they were inverted, right? And that's not good in my view. So this rally was not to be trusted because of that, among other reasons. And now look at the 1505. You're under both of the numbers. So again, it doesn't look good technically in my view. And the people who think there's more to follow, may not be far off. But this market can do whatever it does, but all the different announcements can come out. So you got to be lucid that whatever you do, you have to be prepared for the other side as well. Okay, so there gives you a little roundup of what's going on. And then the big news was, the European, what do you call it? Economic numbers stunk, right? And so what did the bunds do? They went to negative yield. And I heard there's $10 trillion out there floating around at negative yields. What negative yield means, you loan somebody money and they don't even give you your whole principal back if you hold it to expiration or maturity. That's what I understand it to be. So I don't know. That's a lot. And now, if people made a run on that type of stuff, $10 trillion sounds to me like a lot of money, along with $9 trillion in corporate bonds. Now, out of the $9 trillion in corporate bonds, now again, I can't guarantee this information. This is what I read, but I am saying that I heard that a third of it is in triple Bs. And then a third of it, there's two other major parts that are leveraged loans and high yield. Well, triple B, if it goes down one level, people who have to buy investment grade bonds would have to get rid of them because their mandate in their prospectus or whatever means they have to do investment grade or better. Triple B's right there. So if you start dropping those at all, that's a problem. And then, of course, leveraged loans speak for itself, leveraged loans. And then, of course, high yield bonds, with these rates like this, they're getting away with issuing a lot of debt, these companies. And some of the covenants may not be that great. So what do you've got? 10 trillion in negative yields, and you've got 9 trillion in bonds of all different types of valuations. That's a lot of dough. And you've got a budget deficit that this month, I think, did it hit a record, or it was very big. So the deficits are growing, and so the debt market is probably the dynamite that, if they can light the fuse, would cause some problems. You have to keep an eye on that. The good news was on Friday that the high yield market did hold up fairly well, I believe. Let's look at HYG, and you see it's down very little. You see it's way up there. You see the graph. Let's see if you can see the graph a little bit better if I move the cursor up. You can see it went in the dump. When in December. This is why I'm trying to show you. If we get a rollover like we had in December, and I'm not forecasting that at all, but with regards to if you do, can you see these things go down, right? And then, of course, when he does his pivot, Powell, and then bam, they go back up. But now they've made, I wonder if there's a divergence on the RSI here, because you have a high, and I wonder if the RSI during this new high lagged, and that divergence is sometimes a very good sign for selling as well. Obviously, that 85 number is big, and you do have gaps down at 82 and change, and you got a big gap around 81. Will it go down and get those? If we have a big correction, I believe it will. So you got to be careful there a little bit. But the good news for the stock people is the corporate bond people are not panicking. So that led some credence that it could hold up here. That's why next week's very important. 2,800 on the S&P, 2,700 on the S&P are big numbers. All right, let's take a look at some of the other things going on in the world, some of the bigger stocks that you guys might be involved in. Let's talk about Apple. And on Apple Computer, now, like I say, when you think the markets are at high points, as I've discussed on this broadcast before, investigate, learn about how married puts work and how collars work, because they're the ways, like on a collar. I'll give you an example. I gave an example of Boeing. Now let's take a look at Boeing real quick. We'll pop over to Boeing real quick, because I want to give this example so people who are new to the broadcast can get a little familiar on some of the things that I try to let people know that are out there, so they can go investigate it on their own and make their own decision. Okay, so on Boeing, you're at 362. When we were at 440, you see 440 there? I was explaining to people the idea of hedging. And here was what I was explaining. It was a hypothetical example, because it wasn't an actual trade that went on, but it was an example to give you an idea of the pluses and minuses of doing a hedge. Okay, you're up at 440, right? Why would you think about hedging at that point? I'll show you why. You'll get the detailed quote up here, right? And then what do you got? I'll show you what you got. You got the 200-day moving average at 359. At the time I talked about it, it was like 356. So 440 minus 356 is 84 bucks. Divided into 440, that's 20% above the 200-day moving average. My view is when you get 20, 30, 40, 50% above the 200-day average or below it, you got to start thinking about the other side. Why? Because it's overbought or oversold. I'll give you another example in a minute, but let me walk you through this. So what would a strategy be where you're going to use a collar strategy? Well, you're going to take a covered call position, say at 470. Okay, so you give yourself $30 more before they can call you away. You're limiting your upside from the 440 mark to 470, but they're paying you a premium. And that premium you receive, because the market was going so big, you could take that premium and buy a put at 430. So now you've bracketed your equity. You've got maximum upside to 470 because you sold the call, and you've got a floor underneath at 430, and you use the money from the 470 call to pay for the 430 put. Now it's at 360. Now, people who didn't do that on 1,000 shares now have 300. They did have at 440. At 440, they had $440,000. Right, 1,000 times 440. Now they have $360,000. And had they done the hedge, their floor is at 430. And that's quite a bit of a difference between 430,000 if you get that price and 362. Let's take another example of Amazon. And on Amazon, when it was at 2050, I had the same conversation explaining how the collar works. Now, there's more to the collar than just what I mentioned. You have to understand that if you get called away, that could be a tax event. There's many other factors to think about, but I'm just trying to explain the strategy to you so you understand the concept. First of all, when we were up there, the PE ratio was way above 100. Now, and I know that's a high PE ratio. For a company like this, though, people are willing to pay it because they are very, very bullish on the future, right? Okay, but when we were at 2020, see this up here? This was a few months ago before the December drop, right? Right there. Okay, let's look at the 200-day average. It's going to be higher than it was 3 months ago, but I'll tell you where it was ballpark. It was at 1550. You see it's jumped quite a bit because the market was way above it, right? So when you've got 2050 on Amazon, ballpark figure, and the moving average is 1560, let's say, you divide that into the 2050, you're going to be 23, 24% above the 200-day moving average. And again, for a monster company that's 866 billion, that's pretty far extended. So again, there at 2050 area or 2000, you sell an out of the money call, gives you some more upside. So you're not selling out at the market. You're agreeing to sell above the market at the strike price. You take that premium and you buy your insurance underneath. And when you do that, obviously you bracket your equity. It's got an upside max and it's got a downside floor. And that's not a bad place to be. So, in my view, in my opinion. But the point is that the opinion that counts is your own. So do your own investigation. And if you have any questions on it, you can call me. I'll try to fill in the gaps if I can. Optionprofessor@gmail.com. And I can try to give you a hand if you have any questions on that. With regards to whether it's right for you and should you be doing it, that's your decision, your brokerage firm's decision, and obviously your financial advisor and anyone else who you consult or should be involved in the decision-making process. Okay. All right. Let's take a look at what else is going on here. We did talk about looking at Apple. Let's look at all the FANGs. Start out with Facebook. Let's see if the FANGs are breaking. Okay, Facebook 164, and it was down not too much. Of course, this stock's been aired out. Look at that PE ratio. That's not that bad. Again, it does seem to be that the tides of change are swinging on this company a bit. I think they own Instagram, though, and that's supposed to be a pretty big deal. But at any rate, it's a company right now that, is had a big drop, obviously 220 down to 120. I mean, that's almost half price, right? And now it's had a bounce back up and it's having some problem at the 180 area, which you would think, because that's the bottom of the gap that it filled down into. Is it going to be able to shoot into that gap? I think it might if you get above this 175 area. So I'd monitor this stock, and if it can get above 175, it might very well be worth taking a shot. Now, let's talk about where the moving averages are, see if there's any help there. Looks like they should be turning up because the basing has happened. So let's see what the moving averages are. And that can give you a line in the sand as well. Yeah, there you go. But they're inverted again, right? They're inverted again. But they're inverted and the market's trading right around it. So that's not so bad. So you got 160 and change. You got 164 and change. So you're right in the neighborhood. If it can stay here for a while and get above that 175, I think this would be something to take a look at. Obviously, because it's inverted, you start breaking under 160, you're going back in the soup, right? So you've got good parameters here. 175 above looks like it could be breaking out to something nice. If it breaks under 160, then you got the moving averages inverted to the downside, and it would probably be a stand away from it. Okay, let's take a look at what's the next one here? FANG, the A. How about Apple? Okay. Okay, Apple is 191. People have been touting this that it's going back to 225. That's what the touts that I've been hearing on the news been talking about. Today it didn't decide to go there. It decided to come down $4 short than 95. It's had a pretty good run. They have announcements next week on some stuff that's supposed to be exciting. We'll see how exciting it is. But again, when they announced that they weren't going to be following iPhone sales, that obviously was a real yellow flag that people did not like. And So, and also people are saying that the new products they have are fairly expensive, and people are turning towards Samsung or other products in order to get the same type of result without paying the same kind of money. All right, let's take a look at Apple here and see what it looks like. Okay. Obviously, 230 down to 140. That's about the December drop, and that's about talking about not using the iPhone sales anymore, and then maybe Christmas sales stunk a little bit because the prices of the stuff was too high. Now they're talking about services and all types of other ways to make money. I don't know you make the same kind of money on service as you do on the product. We'll have to see. But of course, any more revenue can't be too much of a negative. And of course, they've got other products and services. But again, those iPhones are a big part of the game. And if that dries up a little bit, it's a rough racket to have this thing keep going at the same pace it has. 15 to 1 PE is not scary, though. And then let's take a look at the moving averages. They, and again, there was a reason it stopped around that 200 price. I'll show you in a second. You know, that 200 210 price right here, that's where it failed from. So there is resistance in here. And this first gasp to get above 200 obviously is failing. So that 200 number, 210, would be an area that I'd be concerned about. If it got above that, then of course it opens the book for the 240, 225, 240 that the people are talking about. But let's look at the moving averages, see if they're still inverted. 170, 190. They're very inverted, and that's why I wouldn't trust the rally, you know, really, because of, again, my belief, of course, I could be dead wrong, but my belief is that when you have a situation where the inversion of moving averages is going on, if you get a big market move like we had, the likelihood that it's going to pull back and consolidate, best case scenario, before it keeps going, or that it's a false rally and we're going to go right back down big, is those are the two most probable outcomes that I see when you've got inverted moving averages like this, generally. All right, so that's FA, and what about Netflix? You know, as these things go, sometimes the way the market goes. So if they give it up, you got to be careful, right? Netflix again, all over the place. You know, a lot of money being spent on content, etc. But you know, I heard Julian Robertson, the old hedge fund guy, made a comment. Bad mouthing Netflix is like bad mouthing Santa Claus. I got a giggle out of that one. Because obviously over the long period, this thing has gone through the roof in a big way. Now, of course, it's a come line bet here because the PE ratio 134 is very high. But these people are supposed to deliver growth, 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 and that's why they pay that kind of money. The problem is, like with Amazon, if they announce that they're going to have a 5% drop in Christmas sales, and they're, you know, and you're over 100 on PE ratio, you're going to get nailed, and that's what happened to them. If these people announce anything of slowing down, they're going to be vulnerable to the downside again. But right now, it is kind of holding up pretty well. With regards to the moving averages, let's take a look. They're probably in a positive mode, I would think. Let's take a look, though. You never know until you get them. Moving averages are 351 and 340, as I suspected. You know, so they're in good shape. Nice 340 would be a good place to use as a line in the sand, the 200-day average. 351 on a shorter term basis is a, but the rally here is not on a heavy volume. And that, I brought that to people's attention last week. The rally last week, not this week that just passed, the one prior. Most of the companies on Friday, when I did the broadcast, had low volume despite the market being up, which told me that that could be a non-believer rally. And of course, this week, by the end of the week, they slammed it hard, because if you're running out of volume on the upside, obviously when the sellers come in, there's not a lot of buyers there. Don't forget, it's a merchandising operation. You have to have a buyer for every seller. If everybody wants out, the market makers are going to drop those bids because they're not going to stand in front of a freight train, right? Just like if everybody wants in after December, those markets are going to go way up because the market maker is not going to step in front of a volume, a freight train full of volume. So again, right now, Tom, Dick, and Harry is probably back in the market, and if the thing starts rolling over, you could have some real, you know, gaps in liquidity, and that's the danger here, coming off of this big rally where you've got all the moving averages inverted. Again, that's not a good setup. Not all of them. Obviously, this stock doesn't, but on the major indexes, right? And so you've got a situation where everybody has gotten in on the first quarter. Everybody's thinking that it's blue skies, and everybody's thinking that the Fed is out of the picture, and everybody thinks things are going to be great. Well, that's a lot of people thinking the same thing. And obviously, there's not that many Albert Einsteins running around. So, on a short term basis, if the market has a good reason to roll over, the volume to coming out could overweigh the people who are willing to buy, and that's a risk right now as well. Okay, that's the last one. Going to be Google. And again, if you have a question for me or you want to speak to me directly, it's simple as shooting me an email, optionprofessor@gmail.com. And don't forget to tell your friends and associates again that this is available to them as well. It might be helpful to some of the people out there. Okay, Google, the last of the fangs, down pretty sharply here. Again, P ratio is not scary at 27, really. This is a company that's got a lot going on, right? All of them, though, have that headline risk if the government gets involved in this and that. So that's one risk. This should have a very good cross current of moving averages. Let's take a look. But you are within shouting distance of the all-time highs on this thing. 1273. We recently went above 1200. We're at 1205 now. Yeah, but look at that moving average, pretty far down. Not that far, really, though. You take the high recently of about what, 1220 or something like that, and you take it off the moving average, 1129. What do you get? You get 91 bucks divided into your 1220. Yeah, you're only about 7.5% above it, so that's not too bad when you hit that. It's not that wouldn't worry me. The thing is you still got an inverted 200-day and 50-day, so pulling back is certainly not off the table here. But there's your lines in the sand if you want to use the moving averages, 1124 and 1129. If you're looking at that. That's why people are thinking that if there is a pullback, it might be worthwhile to pick up some stuff because, again, people may be getting a little bit too bearish on our economy, a little too bearish on the economic picture. And so there could be a second half situation that could be positive. But in the short run, we all know we've come up huge in a very short period of time. I mean, you take 2860 ballpark, right? And you take 2350 90 days ago, and you're talking about what? Let's take a look. You're talking about 22% almost on the S&P. That's a big move. Go look at the history, and 22% is a big move. In 90 days, it's an enormous move. What causes that kind of move? The Fed pivots. 90, everyone is short down there. They got to cover their shorts. Then here comes the money from the pension plans. Here comes your IRA money, and all of a sudden you're at 2860. Then all of a sudden we find out that maybe the valuations are getting a little bit high. Maybe the Fed not willing to hike is telling us they think that the economy is going to slow, and so you got people thinking the Fed is telling us something, and then you've got people saying the valuations are out of whack, and then of course you've got Europe falling apart a bit, and there you got a recipe for a correction, which we saw on Friday. Okay, now I'm going to go around the horn here real quick before the end of the broadcast here, and I'm just going to give you a few things that I'm watching real close. I'm looking at GDX because GDX is gold, and we've got huge budget deficits. And if this thing gets, it has been a very good friend to me since last September. This is the gold miner share, and I'll show you the juniors as well, which are interesting. And so, bottom line is this thing is a nice uptrend as long as we can hold above this 21 area. I think it looks pretty good. If we take out 24, there could be a lot more to follow. Look for gold on Monday. If it's way up, that's not going to be good for the stock market because people are going to start saying there's a problem in the situation. The juniors, gold mining juniors. Look at these people. And they were down a little bit today, but they've been getting a little bit on their bicycle lately. Let's take a look. Yeah, they're trying to get going. Again, not for sure. Nothing's for sure. But if you get above 34, these are the ones that can be a little bit more volatile because they're the juniors. Okay. All right. Let's take a look also at the US dollar. US dollar is something we got to keep an eye on. And US dollar is going to be trading at 96. It went up a little bit. People started buying into the dollar, but I'm telling you, if it breaks under 95 and 94, that would be confirmation that there's a problem in the dollar, and I would view that very, very concerning. 94, 95 breaks, then you're going to be having a situation in the dollar. Not yet. Keep an eye on it. All right, let's take a look at one last thing here, which is going to be in the area of oil and the XLE. is down. So again, the oil went up towards 60 and turned around. If the oil can break above 60 and get going, this thing could get back on the bicycle. But the recent highs of this week and last week, I mean this week especially, if it gets taken out, I would become constructive on that. If it goes the other way and starts taking out 62 on the downside on the XLE, that could be a negative. So it's in a critical point right now to either get on the bicycle or go into the fade mode. And last but not least is the 10-year note, which had a big hit on Friday. And 10-year note, what's it look like? It's at 24 and a half. I think this area right around 2.5 is very important. If you go back a long period of time, you'll see 2.5 was very important. But that's a big bust. That's a big bust to the downside. That 260 was very important to hold. And getting above 280 was very important to hold. So there's no question the move on interest rates is still to the downside. The question is, are we oversold? Well, the 200-day average is 2.9. And are we going to see a rebound rally? The RSI is very low. So somewhere in this neighborhood, since everyone has obviously sold out, meaning they're not they're shorting. Excuse me, they're buying bonds. They're buying into the Treasury note. Since everyone is buying in, again, it is a little bit overbought, which means this is a little oversold. So be careful getting too negative down here because we might not be that far from the low. Keep an eye on it. All right, that's it for today. And again, I'm Jim Kinney. I love talking to you guys once a week. I'd love to hear back from you. A little bit more input would be great. Just email me, optionprofessor@gmail.com, and I'll be more than happy to work with you on it. Give me some contact information, and I'll speak to you then. Don't forget, tell your friends, optionprofessor.com is where you get the link to this broadcast, and I'll be back with you next week. Until then, good luck, good trading, and enjoy the rest of your weekend. Thanks.